treasure or trash part 2 of the video. Again, if you've not watched part 1, pause part 2, watch part 1, and I'll see you guys back in a couple of minutes. Alright, so assuming you've watched part 1. In part 1, we answered a few questions. Question number 1, these Chinese stocks have dropped 50 to 70%, Alibaba, JD, Tencent, Yum China. Is there anything wrong with the actual underlying business? Are the businesses still intact? The answer that we found was yes, they are still growing, although slower. They are still extremely profitable, they are financially very stable, they are still generating cash. And they are worth a lot more than what the market price shows right now. So like we said, in the short term, market price is not driven by the fundamentals of the underlying business. In the short term, market price is driven by news, emotions, manipulation, and sometimes forced selling because of forced liquidations, because of margin calls. So that's causing the share price to be way below the intrinsic value of the businesses. And then we ask a few questions. Why are some investors panic selling? What are their concerns? And again, the concerns, are they rational or irrational? Are they short-term concerns that will be resolved, or are they long-term permanent concerns? So the first concern that we talked about was the concern that these China stocks listed in the US could get delisted in the next 2 years. And like I said, I have got no concerns about this because the China stocks that I own, they are also listed on the Hong Kong exchange. So even if they are delisted in 2 years, which I doubt, but even if they are, no worries, because your stocks will simply be swapped into the China stocks that will continue to be traded in Hong Kong. You just have to ensure that your broker allows you to trade Hong Kong stocks. So if you have a stockbroker like TD Ameritrade that can't trade Hong Kong stocks, that could be a bit of a problem, right? So you want to get a broker like, for example, Fidelity or Interactive Brokers, where you can easily transfer your holdings to the Hong Kong market. So that's concern number 1. So what are other concerns that people have? So another concern that I hear a lot from investors is, Adam, the CCP, they are communists. And these communists, they hate capitalism. They're out to destroy these companies or nationalize the companies. They all go to zero. Okay? Now, first of all, people have this biased perception that they are communists. And communists hate capitalism. Now, if you really understand China, you understand that China, yes, although the party is called the Communist Party, it is not communist. Now, it is authoritarian. Yes, it is not a democracy, it's authoritarian, but it's not communist, right? It is capitalistic. And the Chinese government knows that capitalism is good because it is what has created a lot of wealth in China. It pulled 800 million people out of poverty. So they need capitalism. In fact, if you listen to the recent speech by the Chinese premier during their party congress, he kept emphasizing that they want to focus again on innovation, entrepreneurship, and they're very happy with foreign ownership of their companies. So this is totally an irrational concern. They are promoting entrepreneurship, capitalism, and so on and so forth. Now, having said that, there is a concern that I have that, yes, the Chinese government, they have been regulating a lot of businesses. And for the most part, a lot of the regulations I've mentioned in previous videos, I think are warranted. Okay, so for example, they wanted to get rid of unfair monopolistic practices, which is a good thing. They want to reduce unfair inequality. And so a lot of the regulations are good, but they can get a bit overhanded at times. Okay. Now, the thing about in the US, for example, in the US, they want to rein in big tech as well. They want to stop a lot of these monopolies, but they don't really execute as well because, again, it's a democracy, so there's a lot of debate and there's a lot of check and balances. But China is an authoritarian system. So if they want to regulate, they do it right now. Okay. So because of that, it has slowed down the growth of many of these companies. So again, Alibaba and Tencent, they are still extremely strong, they're still dominant, but they are not the monopolies they used to be, right? And they are not growing as much as they used to be because of these additional regulations. So for example, in China, the moment a company or an industry, they go against the values of the country, they would regulate it. So for example, they want to stop addiction, gaming addiction among teenagers, so they don't approve a lot of the games, the new games by Tencent. So will that slow down the growth of Tencent? Yes, it will. But the good thing is Tencent is now expanding internationally outside of China, where they are growing again. So they are getting around these regulations. So same thing with Alibaba. Alibaba used to be unfair monopoly. They do not allow their merchants to sell on competitors' platforms. So the Chinese government, they hate these monopolistic unfair practices, creating inequality. So they stop that and say, no, you have to open up your platforms. Yes, could be a fair playing field, which I think is good, right? In the short term, in the long term, it's good. But in the short term, it definitely slows down the growth of Alibaba. But again, they're getting around that by again growing their international business. So that's the first concern, like I said, or the second concern, like I said, to me is irrational. But having said that, the regulations do slow down the businesses, and they do put a cap to how much they can grow as compared to before. Now, concern number 3 is the slowing growth of the Chinese economy that has again caused slowdown in revenue for a lot of the Chinese companies. So is this a legitimate concern? Yes, it is. But is it a long-term problem? No, it's not. It's a short-term cyclical problem that happens in all economies. So it's been kind of like a perfect storm of events, right? China is going through this property slump because they were reining in the highly leveraged property companies last year. Rising US interest rates are not helping, all right? Now you've got the Russian invasion of Ukraine that's causing a spike in commodity prices, oil prices, and they've got this COVID-19 zero policy lockdown. So all this has come at one time. That's causing a slowdown in the Chinese economy that used to grow at like 8-9%. And this year they've set the lowest target in decades of only a 5.5% growth. So yes, it is a legitimate concern that's causing slowdown in the companies, but it is a cycle short-term issue. They will grow again like every other economy. Now, another concern I've been hearing is, could the US and Western nations start sanctioning China because of their relationship with Russia? So what happened was that before this invasion, it seems that they were kind of like buddying up together, right? Russia was like going to China and saying, hey, let's be friends. You come to my place, we ride the horse, the bear together without the shirt on, right? And China was like, okay, together we will gang up together against the Western nations that are very unfair. But what happened was Russia went ahead, invaded Ukraine, and China was caught by surprise. And if you listen to what China is saying now, they are like, they don't want to be associated anymore with Russia. It's like, you are on your own, brother. You don't ask me for help anymore. Right? So, because China needs the West a lot more than they need Russia. Because Russia's GDP and their trade is still very small compared to China's trade with the rest of the world. So that is definitely not an issue. All right. So China is starting to, I mean, they're not totally condemning it, but they're kind of like, they don't want to be associated with Russia that much anymore. Because again, for China, the main focus this year is stability, and growth. And China is in a way screwing up their show. So they're getting a bit pissed. Like, you are on your own, brother. Don't involve me anymore. So that's not really a concern. Now, of course, then the other concern people have, seeing that Russia invading Ukraine and their entire economy getting decimated by sanctions, everything going to zero, could that happen to China? Could China attack Taiwan and the same thing happens? Honestly speaking, I have that concern as well. All right, that China may attempt to take Taiwan. But if you ask me, I think that this Russian invasion of Ukraine has made China think twice. Like, it is not so easy. I thought I could take Taiwan. Now Russia get their ass kicked. I too should not do it. If not, I will get killed by the international community. So I think that in a way, the blessing in disguise is that China has realized that, it's not so simple to take a country, right? I'm not saying it's not going to happen. Anything can happen in life, right? So, but I think that this has caused China a lot of thought that, I should not do something like this, like Russia did, because that could destroy my whole economy. And for China, what they want to do is they want to become a world leader. They want their Chinese yen to be a global reserve currency. They want to match up to the US. And they now realize that if they attempt something like this, everything would be destroyed. Okay, so I doubt that concern will become a real problem down the road, right? But the US sanctions against China, I don't think that is something to be really concerned about, right? So these are the main concerns that I think are causing people to freak out, dumping the shares, and that's why the share price is now trading way below what the actual underlying businesses are worth. So bottom line, what should intelligent investors do? Should you sell? All right, should one sell? Now, I have not sold a single share. Why? Because to me, if there's nothing wrong with the underlying business and I don't need the money, all right, I've got the power to hold, I'll just hold it because it will recover eventually. When, I don't know exactly when. Obviously, I tried to call the bottom a few times. Now I look like an idiot because it kept going lower. So I'm not going to do it again, all right? But I'm not selling, all right? Now, am I holding? Yes, I've been holding, all right? And I'll continue to hold the shares. Now, I know some of you are thinking, but Adam, it keeps going lower and lower and lower and lower. I keep getting kicked in the nuts. And I don't like to be kicked in the nuts. It's really painful. Remember Casino Royale? When someone straps you in a chair and hits your balls, you can scream in pain or you can enjoy it and say, yeah, come on, man, it's itchy. Scratch me there, scratch me there. So what do I mean? What I mean is that, yes, you can hold on to the stock. If it's going down and you don't like it, you could make some short-term profits by shorting the stock using options. So long-term, you hold the stock, but you short it using options and you make profits while it goes down. So I've been doing that as well. So I've been making a couple of $1,000 actually shorting Alibaba. And I mentioned this many, many times in my previous videos. So back in December last year, if you recall, I actually shared this video on how I use options using this back ratio strategy and also a bear put option strategy, so that when Alibaba goes down, while my stocks are temporarily going down, but you'll come back eventually, but in the short term, I can make some extra money by using options so that when the stock goes down, I'm actually making quite a bit of profit. So I've made a couple of $1,000 in profits by shorting Alibaba using what we call back ratio spreads and also bear put spreads. Now, I won't go into that in detail here because it's going to take another, 20, 30 minutes. But, if you're interested to learn about how to use options to hedge your portfolio and to make some extra profits while it's going down, so while your balls are getting kicked, you can enjoy it in the process, right? You can take our options trading course on piranhaprofits.com. But again, a word of caution, if you are shorting any stock, never short the low, always short the high. What does that mean? So remember that when a stock goes down, it doesn't go down in a straight line like that, right? A stock goes down like that. Wave down, wave up, wave down, wave up, wave down. So if you want to short a stock, wait for a wave up, a temporary rally to a level of resistance. And then at that level, you could do a short trade, like using a bear put spread option or using a ratio spread option. Again, these are taught in our options trading course. So for example, if you take a look at Alibaba right now, you can see that, the downtrend prevails. As long as the downtrend prevails, in the short term, the price could still go lower because of negative sentiment, right? So, wave up, wave down, wave up, wave down, wave up, wave down. So you can see these wave patterns here, right? So again, if you want to short it, don't short it at the bottom. A lot of people, they make the mistake when it drops, they panic, they short it, it goes up and they lose money, all right? So if you want to short it using options, wait for a rally to this resistance level, right? There's a resistance here. You can short it and make some profits as it's going down. And at least you can make some short-term profits while waiting for your stock positions to recover. And they will recover in time, okay? Now, so the third question would be, okay, Adam, are you adding more shares? The answer is I will add a bit more, but not too much more shares. Why? Because one of my rules is this: whether is it China stocks, US stocks, any stocks, what's really important is the rule of diversification. I never allocate too much of one stock in my portfolio, no matter how good the business is. So for example, one of my rules is that I never allocate more than 5% allocation of any stock in my portfolio. Again, whether it's China or the US, it doesn't matter, right? And overall in my portfolio, I'll never allocate more than 20% of an emerging market into my portfolio, whether it's China or India or whatever it is, right? So it's always important to maintain that diversification and that allocation. So I will add a bit more, not just yet. So what am I waiting for? I'm waiting for a change in the trend. So currently you can see that it is a downtrend. So how do you recognize a downtrend? Again, price is making lower highs. Okay, this is a high, 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 high. So it makes lower highs and it makes lower lows. As long as you see lower highs and lower lows, let it go down, right? Because it's broken all long-term support levels, so there are no more support levels. You have to wait for a reversal in the trend. So what do I want to see? I want to see a reversal so that we begin to see something like that, right? We see higher highs and higher lows. So once I see that, I would start to add a bit more to my position, right? You can also take a look at the moving averages. When you see the 20 EMA crossing above the 40 EMA, that's the first signal of a change in the short-term trend. And when the 50 moving average, the blue line, crosses back above the green line, the 50 crosses back above the 150 and it starts sloping upwards, that is a stronger confirmation in the larger change in trend. So that's when I would then want to add back more to the position, right? But for now, it's a downtrend, so I'll stay out. And this was what I did as well, like I mentioned in previous times when I bought a stock that had fallen dramatically, like American Express and Schlumberger. So this was again this was a more recent example of a stock that I bought that dropped dramatically as well. Now, Schlumberger dropped from $80 all the way to about $12. So it was an 85% decline. And again, it was the same thing. There was really nothing wrong with the business. It was a good business. It was extremely undervalued, but it was irrational selling because of oil prices collapsing. Okay. Now, I didn't buy it at 80, all right? I bought it at, now my intrinsic value calculation for SLB at that time was between 44 to 48. So that was my valuation. So I bought it actually here. I bought it at about $32 because it was at a very strong support and it looked like the trend was changing. So I bought it somewhere here, 32, 35, and then boom, it collapsed again. I was like, okay. But I didn't sell it because again, I said great business, undervalued, just held it, right? And so it went all the way down. So what happened was I began to add a bit more when I saw change in the trend over here. So you can see over here, the 50 crossing back above the 150, the trend is like changing back up. So I added more here. I added, I think about $18 thereabouts. So it lowered my cost price by quite a bit to about $20. And eventually I sold it at about, I think I sold it about 27, 28, right? So I made a bit of money on it, not a lot, right? And of course now it's gone even higher, should have held on, done it. Right now it's up to $42, right? And same thing with American Express. So American Express, that was quite a while back, all right? So this one happened quite a while back. Let me use weekly candles because it's quite a while back. This was during the financial crisis, right? So take a look, guys. You know, it's not just China stocks. It can happen to any company if the sector gets whacked for some reason, right? So, you know, American Express went from like $65, okay, all the way to as low as $9.70. So that was an 85% decline, right? No, I didn't buy it at 65, right? I bought it lower, right? I made a lot of money on this one. I got out and then I went into Visa and MasterCard. So as an investor, like I said, the most important thing is you gotta have the patience, you got the skills, and you will make money. But you gotta stick to only fundamentally good businesses. So while I will be adding more shares once I see a change in the trend, but I won't add that much more. So like I said, my current allocation to the whole of China stocks is about 12%. At the very most, I'm gonna add it back to maybe 15 or 16%, and that's it. Now, some people say, why, Adam, if you're so confident that China companies are great, why not 100%? Well, it's because while China looks really attractive right now, US stocks are also getting very attractive, right? So Visa, MasterCard, Amazon, Google, and Facebook, they're all getting really, really attractive. So between the two, now, they are both great companies in two markets, right? But between the two, I prefer to put more of my money into the American girl. Why? Because she doesn't have a strict father. Her father's like, do whatever you want, go out late, come back whenever you want. Okay, daddy. All right, but whereas the Chinese girl is attractive, but she's got this really strict father, where you never know, you could call up once in a while and says, it is getting late, you bring my daughter home right now or I chop your head. All right, so between the two, I prefer American. Less regulations, and I think a lot less uncertainty. Although they are both pretty attractive. Okay, hope you enjoyed this video. Again, you got questions, post them on the chat, but please ask logical questions. Don't post some kind of personal bias, batshit crazy shit that some people post. All right? Okay, so I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.